Welcome to everyone. We are expecting a great turnout today, and we thank you all for participating in this webinar. Let me begin with a brief overview of how this webinar will be run, and then I'll introduce our facilitator. My name is Jessica Alfaro, and I manage membership services at SBBN. I'm very pleased to have met or communicated with several of you earlier and to meet with the rest of you today. We've gone ahead and muted all the voice lines going through to improve the sound quality, but we do encourage you to submit your questions by typing them into the chat box on the GoToWebinar app. There will be several times throughout the presentation that we'll be asking from your input, so we would appreciate and look forward to hearing your thoughts at those times. So at this time, I'd like to go ahead and introduce our very experienced facilitator. Cecilia Deekdeekian is a development banker specializing in credit risk management for micro and SME-oriented institutions with almost 30 years combined experience in mainstream banking and in MSME consultancy. Her microfinance consulting work started in 1999, and she has assisted more than 20 micro and SME-oriented financial institutions in Asia and Africa with remarkable successes in bank turnaround and assisting startup microfinance operations. So at this time, we'll turn it over to Cecil, who will take you through the webinar.
Thank you, Jessica. So welcome once again to this webinar. I am Cecil Deekdeekian, and I am happy for this opportunity to facilitate this webinar and to be able to share with you some of my experiences in this field. I am also excited to hear your own stories and to learn from your experiences. I know that this webinar will be very enriching, and I look forward to your active participation in the discussion. We will be talking about the importance of training SME loan officers. One of the winning strategies in SME lending is having appropriately trained loan officers with the right mindset. The CEO of one of the client banks that I have handled before said, forming SME LOs is a test of endurance. But if you do it well, it will turn out to be very rewarding and the benefits are long-lasting. He further said that you shouldn't just do it. You have to do it right. If you take care of your loan officers will take care of your business. So for this webinar, the topics will revolve around the challenges and best practices in forming good SME loan officers. We will begin by discussing their roles and responsibilities to refresh our understanding of what SME LOs are expected to do. We will also take a closer look at some of the qualities of a good SME LO, because appreciation of these aspects is the foundation of knowing who is a good SME LO. We will also talk about the approaches and best practices in training SME loan officers. A loan officer's job is very challenging. They carry the pressure of growing the portfolio and manage risk at the same time. Volume over quality or quality over volume. This is always the dilemma that LOs face day in and day out. Obviously, the answer is both. Indeed, LOs are capable of achieving a good balance of volume and quality. Then the next question is, how long will they be able to sustain it? Left on their own, LOs will not be able to sustain a well-balanced performance. They need management support by creating an enabling environment to keep a well-balanced performance consistently. Creating an enabling environment consists of bringing in the right people, putting in place the right guidelines, controls, and support to motivate LOs. An incentive scheme with parameters composed of a good combination of volume and quality is also an effective tool that will help SME LOs balance their roles as sales managers and risk managers. Now let's have a look at the responsibilities of an SME loan officer. As we said earlier, They are sales managers and risk managers. As sales managers, SME loan officers are responsible for identifying prospects, packaging and concluding deals, cross-selling other products and services, and building relationships with customers. As risk managers, they are tasked to screen applicants in line with the credit policies, evaluate the risk components in a loan proposal, and to maintain good loan portfolio quality. Traditionally, loan officers' responsibility was purely selling loans. They were seen as sales manager, but over time, the product array continued to expand across the financial services spectrum. This rapid growth in the products and services paved the way to the evolution of the LO's role. Apart from selling loans, LOs are now responsible for cross-selling various products, either directly or through referral. Now the LO is responsible for not only making loans, but for also acquiring and developing profitable customer relationships by hooking other business products. This change in roles has resulted in myriad new titles to describe that position, from loan officer to relationship officer to relationship manager. Before we go to the more technical stuff, let us talk about the qualities of a good SME loan officer. Why are these important? As mentioned in the previous slide, the LO's role centers on relationship building, and so personal traits of the LO counts a lot. I consider these 6 qualities: integrity, positive image, critical thinker, proactive, good communicator, sound advisor as the most important ones. And here's why. Fraud is one of the major killers of the lending business. And so to mitigate the risk, you should hire LOs with integrity. You have to do a good diligence before hiring any candidate. LOs are the institution's ambassadors. The way they present themselves influences the customer's impression of the institution. It is very critical, therefore, that a loan officer has a positive image to project a wholesome image of the institution. SME LOs deal with complex customer circumstances, and customers can be very tricky sometimes. A loan officer who thinks critically is able to analyze each case comprehensively. These are loan officers who entertain a lot of what-ifs in appraising a loan. In this very competitive business landscape, LOs cannot afford to just wait for customers to come. A good SME LO should be very proactive to anticipate and satisfy clients' needs. Exceptionally proactive LOs can and will take business away from someone. This is the trait that makes it possible for them to easily prevail over their competitors. The customer's appreciation of the products and services that loan officers sell depends on how well the LOs communicate the product's competitive advantage. In the same manner, the credit analysts and loan approvers' action on the loan proposal is highly dependent on how loan officers present the proposals. I have witnessed many cases where loan proposals get rejected by the credit committee because of the LO's failure to communicate the true circumstances of the borrower. In some of my client visits, I have come across customers who have not done business with our bank because they have no idea of the competitive features of our products. So if the LO falls short in communication, the bank could lose money from missing out potential good customers. In dealing with low-profile entrepreneurs, giving sound advice counts a lot. One thing that kept client retention rate very high in one of the banks that I have handled before was the customer's appreciation of the simple but sound advice that loan officers gave. For example, some of our LOs taught clients the value of keeping simple, updated records of sales and purchases so they can track changes in prices and changes in their margins. Some LOs taught the clients simple cash flow analysis. Being informed in these aspects means a lot to the customers. It has strengthened the relationship, and more than that, in the end, the LOs also benefited because it became easier for them to extract business information in the succeeding loans. Isn't it smart? Now, I have a question for you. In what aspects do micro, SME, and corporate LOs differ? So micro, SME, and corporate loan officers differ in at least two aspects: their qualifications and personality. For qualifications, some institutions hire high school graduate for micro loan officers. For SME LOs, they require at least a certificate course. And for corporate LOs, they require business-related degree. Failing to distinguish an SME LO from a micro or corporate LO can hinder clarity in expectations and performance standards. Some managers think that an SME LO should not in any way be different from a micro or a corporate LO. They are all in the business of selling loans anyway, they say. But that is not the case. The fact is, micro, SME, and corporate LOs differ in their qualification requirement and in their personality. Matching LO's personality with the profile of their target customers is very fundamental. This lays the foundations in building good relationships. A good micro LO deals with low-profile customers. Therefore, you do not need to get a university degree holder for this position. Some big MFIs hire high school graduates and build them up internally until they reach more senior positions. On the other hand, corporate LOs deal with high-profile, well-educated businessmen. Therefore, it is a must that these LOs possess much higher education so that they can deal with high-profile businessmen. The SME LO stands in between. He or she must be capable of dealing with clients above the grassroots level and those that are not as formal as the corporates. One of the banks that was handed over to me to manage was in a very bad shape because of serious manpower issues that eventually led to very high PAR in the portfolio. The staffs were in the final stage of forming a union affiliated with a very radical, left-leaning Federation of Employees Unions. So you can imagine the mess that I have gotten myself into. I got down to the bottom of the issue, and you know what I found? All the mess were caused by the wrong choice of loan officers. That bank was a microfinance-oriented bank, but they hired A1 students from the most exclusive school in the city. Naturally, those LOs could not persevere in the field. They were harassing customers, and they kept asking for salary increases to sustain their high lifestyle. Discontentment in a lot of aspects led to serious problems in the portfolio. Now that we know the distinctions of a micro, SME, and corporate loan officer, the next question is, should you train them the same way? Loan officers training has a lot of common fundamental contents that are relevant to micro, MSME, and corporate loan officers. For example, risk management is a cross-cutting component in training all types of loan officers. Let me share with you some of my notes on the training approaches of some of the big names in the industry, namely Bank Rakyat Indonesia, Akleda, KREP, and BRAC. The Bank Rakyat Indonesia has continuous training program for existing loan officers and would-be loan officers like tellers and back office support staffs. The training program includes classroom and field work. They even have support for their loan officers to take higher degrees, master's, and doctorate degrees. In Akleda, they train LOs for 3 weeks. with 4 days field work. In KREP, their training runs for 6 weeks with 3 to 4 weeks field exposure. Then follows 1 week classroom training after the field exposure. At Brackbank, they do 1 to 2 weeks training with field exposure or shadowing with senior LOs for approximately 2 months. The training courses also vary in the activity level, the course content, and delivery method. For example, Micro LOS training requires more intense field work and post-training shadowing. SME LOS training requires more classroom sessions, lectures, workshops, and case studies, and substantial inputs on basic financial analysis. Corporate LOS training is much more sophisticated and runs for a longer period using a modular approach. The tools that they use also differ. Simple cash flow templates are used in training micro loan officers. For SME LOs, simple 12-month cash flow template and ratio analysis are used. For corporate LOs, mastery in using automated loan assessment tools is required. Fieldwork is vital in training micro, SME, and corporate loan officers. For SME and micro loan officers, 70 to 80% of their work is in the field. Unfortunately, some institutions do not expose their newly hired LOs to the field during training to cut on training days. When real work comes, they face hesitation or even resistance to go out to the field because they were not told to do so during the training. One cannot appreciate the profile of his or her target customers without interacting with the same people in the field. It is in the process of field visitation that loan officers are able to get a clear picture of their way of doing business, which is an important eye-opener that paves the way to changing their mindsets. The issues informing loan officers affect the institution and the loan officers themselves. Institutions are battling to decide whether they should have generalist or specialist loan officers. Experience tells us that having specialist loan officers is always beneficial to the customer, to the bank, and to the loan officers most importantly. We have discussed earlier the distinct characteristics of micro, SME, and corporate loan officers. These distinctions are aligned with the profile of the customers that they have to deal with. A mismatch in the personality of the loan officer with the profile of customers will lead to serious operational issues. Secondly, training can be expensive, and to many, training is seen as a huge expense. In most cases, management would look for the cheapest training resources to cut on costs. Well, institutions that appreciate the long-term financial benefit of good training will not settle for less when it comes to allocation of time and resources for a good training. New loan officers, on the other hand, don't have a clue on how to best deal with SMEs. This is such a big struggle, especially for micro LOs or corporate LOs moving to the SME business. They will initially feel lost if they don't have a clear idea of the similarities or differences in the way of dealing with SMEs. Now we have another question for you. What approach do you use in training SME loan officers?
And Cecil, let's pause just for a moment to give people a chance to type their answers into either the chat or the question area, because we would love to hear from you. And we've had some different responses in terms of some of our financial institutions do more of a general training and some do more of a specialist training. It looks like some of our other institutions are doing more field training and more exercises, and a lot of mixed training with both an emphasis on the field and the classroom. Great. So it looks like our institutions are doing a combination of both the field and the classroom work, and then also trying to do quite a lot of on-the-ground training as well. So actually doing exercises to prepare the loan officers to work with their clients.
Okay, so now let's talk about the challenges in forming SME loan officers. In my interaction with senior managers of SME banks, I always ask them what their challenges are in forming SME LOs. Amongst other things, they would mention aligning behavior, strengthening technical skills, and managing cost. Of the three, aligning behavior is the most critical, unanimously. Well, behavior makes or breaks a loan officer's performance. Good behavior results in good performance, therefore adding value to the business. Bad behavior, on the other hand, brings nothing but problems. Dealing with behavior issues derail managers badly. They not only sap energies and resources, they also take managers' time away from the good performing guys. Strengthening technical skills is also a key challenge, particularly in the aspect of choosing the right approach that best suits their loan officers. Finally, not cheap, and not all institutions have enough resources to allocate for a good training. SME LOs are also confronted with challenges in relating to their customers, especially if their background was in micro or corporate lending. Secondly, being new to SME lending, the low level of competence affects their confidence in dealing with customers. They need a lot of support from managers until they pass this difficult stage. Forming SME loan officers follow a cycle. This cycle lays the foundation of a strong mechanism in forming SME loan officers. Many institutions expect that one-time training makes expert SME loan officers. That is not realistic. The appreciation of putting in place a full cycle composed of identifying skills gaps, defining training objectives, customizing and implementing training program, evaluating training output and training outcomes is quite low in most cases. Only few institutions see the importance of following all components of the cycle. The illustration of the training cycle indicates two important things. First is that the training content should all be aligned with the institution's vision, mission, and values. And second, the components of the cycle should be seen as the requisite for reaching business goals. Many of the banks that I have known would only pick some of the components of the cycle. The components that are least appreciated are identifying skills gaps, evaluating training results and outcomes. The problem is, you cannot come up with the most appropriate training course if you do not know the learning requirements based on skills gaps. And you wouldn't know if the training that you have spent money on is effective or not if you do not evaluate results and outcomes. Well, cherry picking just doesn't work. Another way of measuring training outcomes is by tracking observations from the loan files submitted by loan officers at different levels. Loan file reviewers as managers, credit analysts, credit committee, credit compliance team, and loan monitoring officers should compile their observations sorted by loan officer's name to be collected by the loan officer's team leader, who will then summarize all observations. Normally, these observations are submitted to HR as basis for designing the follow-through training. Bottom line is, good results come only if every component of the training cycle is followed. Why do many institutions consider training as a huge cost? I have always heard responses like, we have spent a lot of money on training, but we cannot see any improvement in our loan officers. This kind of response always challenges me, and I would always push to see how they do their training. Most of the time, institutions use copied and pasted training materials. They are not customized, so there is no way that the training will yield good results. In many instances, I see good materials, but when I look at the training records, a big chunk of the program is submitted to cut on cost. No post-training evaluations, and in most cases, no assessment of training outcomes, and no follow-through refresher courses. Doing training this way will never yield good results. Instead, they will only be a waste of time and money. Here are some of the best practices that have led to the success of many SME banks in forming SME loan officers. First of all, they choose candidates with the best fit. They customize skills development program. They create ongoing peer learning mechanism, both internal and external. And they always pay attention to skills gaps. Forming good SME LOs begins with good selection of candidates. Choosing candidates that are best suited for the job you have to customize your training program to bring their skills to an acceptable level. Again, copy and paste is not the right thing to do. I always come up with variations in training materials for every training course that I do to match the profile of the participants. For example, if I train a batch of neophytes, I customize a program that puts more emphasis on the very basic principles in SME banking. If I train experienced LOs, I only do a very brief review of the fundamentals and put more inputs on deepening analysis. I always pay attention to the areas where trainees are weak, and I beef up my training materials in this aspect. Most of the batches that I have recently handled had very low competence in accounting, for example. In such cases, I give more accounting exercises until I see an acceptable knowledge level based on their scores before I proceed to the other topics. Peer learning is another very effective component in forming SME loan officers. The sharing of experiences with external and internal peers will enrich their knowledge and help build confidence. My experience in implementing peer learning has been very interesting. In most cases, it has strengthened the bonds among loan officers within and outside the institution. Having someone they can call when they are facing challenges in their work was extremely helpful, mainly because the advice that they get from their peers are all based on field experience. Paying attention to skills gaps is critical. It allows you to see whether a loan officer's skill is improving or not. To be able to pay attention to skills gaps continuously, you need tools that will give you a relevant information that you need in order to proceed with your LO's formation. Some of these important tools are baseline skills assessment, post-training report, and performance appraisal results. A baseline skills assessment helps you identify the learning requirements of the new hires and to customize your training program accordingly. After each training, a post-training report is prepared by the facilitator to summarize trainees' performance, issues and challenges encountered at the training, and the trainer's recommendations. This will serve as reference in determining who among the trainees would need more training or much longer mentoring. Finally, the periodic performance appraisal result will help you assess the level of competence and areas that need improvement. This will be a refresher course training with the goal of enriching their skills and improving performance. Persevering in doing this process is vital to forming good SME loan officers. So a very important take home for you from this webinar is the importance of putting in place a good SME-LO formation mechanism anchored on the formation cycle that we have discussed. Remember, training is just an event, a single component of the entire formation cycle. And remember also that picking only the most convenient parts in the cycle weakens the overall formation process and will water down the quality of results. With this, let me end my presentation and thank you all so much for your time and your participation. We will now open up to any final questions from anyone.
Great. Cecil, thank you so much. And we're going to pause and give some time for our attendees to either offer some questions, and I'd also love to hear about any real-life examples that any of our attendees have in terms of either best practices or maybe the opposite. You know, if you have any challenges in terms of loan officer training, we would love to hear that as well. So please go ahead and type in any questions that you have at this time, and we'll provide those to Cecil. And we did have a question in terms of the peer learning and how you could set that up. You know, obviously time is limited, resources are limited, so maybe you can give us an example of how to set that up when resources are limited.
In some areas where microfinance industry is a bit developed, they usually form federations, like a federation of SME operators or microfinance lending institutions. Now, it would be good to encourage, if there's nothing in place yet, to create something like a roundtable discussion for loan officers coming from the member banks. In that way, they can meet like once a month or once every 2 months to share their experiences. Now, this is very important, especially for new LOs, because then they hear inputs from the more senior ones. They discuss, they bring out during the roundtable discussion their concerns, their struggles, their problems with this and that customer. And that is where they get a lot of inputs.
Great. Okay. And it looks like we had a comment that the experience of a loan officer really does matter to deal with the clients.
Yeah, that is very true. But when you talk about experience, especially if this is experience from a different institution, that could also be very tricky. If it is the experience within your institution, yeah, I believe that that is very critical and you can build up on that. But if it's experience from another institution, you have to dig deeper into that experience, because oftentimes that experience could also be like a stumbling block for them to adapt the approaches that you use. Right.
That's great. And we have a wonderful suggestion from Victor at Planters Bank where he suggests peer learning equals pizza meeting. And so what they've done is they've opened up sort of a safe zone for people to discuss by having it as a lunch for individuals to come together. So they do the peer mentoring during a lunchtime. So they have Pizza Fridays is what they've done, and that's opened up and given their sales officers some time to get some peer mentoring, and then they're incentivized to come as well because there's lunch that's been included.
Yeah, you know, that's a very great sharing, because loan officers are more inclined to share experiences, to open up in a very informal setting. If you bring them to like a very formal forum, they hardly speak up, especially the new ones. But if you bring them to something like a pizza table, a pizza discussion, then they will open up.
I think that's a great idea.
Yeah, when very juicy ideas come out.
Sometimes the best ideas, right? When people are comfortable. We actually have a question from one of our partners in Southern Africa. How do you deal with a market environment that has both low and high profile customers for a single loan officer? So they've really got to have very varied experience. So how could you, expand upon that and give us some best practices there?
Mm-hmm. Now, this is where the question of either having a specialist or generalist loan officer comes in. As we said earlier, experience shows that putting in specialist loan officers is always the best. Now, dealing with profile of customers, most especially, is a very big issue. If you put in place, for example, a loan officer with a low profile, he or she would chicken out if he is facing a high-profile loan officer. Now, if in some environments, they would say also that looking for loan officers, for high-profile loan officers, for example, is also difficult. So in that way, what the institution can do is to provide training support, formation activities that would bring up the skills of the loan officer. If most of your loan officers, for example, are comfortable dealing with low-profile customers, then give them more training on how to deal with high-profile customers. On the other hand, if your loan officers are more used to dealing with high-profile customers, then give them more support to feel comfortable in interacting with low-profile customers.
So it sounds like it's still going to be specialized training, but it's very much customized to the skills of the loan officers. So again, it's coming back to that skills gap.
Yeah.
Great. It looks like we have a few more questions coming in, and just wondering if you could share any other best practices to strengthen loan officer training.
We have mentioned customizing training, identifying skills gaps, evaluating results, evaluating outcomes, and conducting refresher courses. Now, some of the institutions would also form like committees to evaluate the overall training program. Sometimes it takes an independent eye, for example, a team of officers who are not in any way involved in the training. Those outside the HR department, they would pick 2 or 3 managers from operations, from internal audit, to some sort of critique the training program and to critique the results. Now, in that way, those that are tasked to do the training program and to deliver would be guided accordingly. You know, sometimes when you're inside the forest, you hardly see what's in the forest because you're so used to it. Now, having independent eyes to look at the program itself, the quality, the results, the outputs, the outcomes, would help a lot.
Great. We have another question from one of our members in West Africa. How do you design a remuneration model for loan officers based on volume and quality? And also, if we already have any models that are ready that we're able to share, or if you have a good example of one that could be shared.
Designing compensation is best done internally. You know why? Because different institutions have different cost profile.
Okay.
Yeah. Now, your cost structure is the #1 factor that you have to consider. And then you would say that, for example, for to break even the cost of one loan officer based on our operating costs and all that stuff, the loan officer would have to be paid this much at the entry level, and the expectation of productivity is like this in order to recover this cost of carrying one loan officer.
So it really needs to be done on a case-by-case basis.
Yes, and internally.
And internally. Okay, since the cost structure is so different. Yep,
Yeah.
that makes sense. We also had a question about setting up loan officer teams. And before we get to the question, I will just say that some of these items that you're asking for, we actually do have in our SBBN knowledge bank. And I think for this one specifically, we have something in there, a document of how to set up an SME department. So the question is whether or not it's better to have account relationship officers handling existing accounts and a set of loan officers sourcing new accounts, or if it makes sense to have universal account officers handling both the acquisition and then the maintenance.
Well, the best practice is to have one and the same loan officer to source the account and to maintain them. That is the best way to build relationship and to deepen the business relationship and open the opportunity of selling more products to the customer. Now, can you imagine if you entrust sourcing of accounts to specific loan officers and over time you hand them over to another loan officer? So the customer will have to be dealing with different LOs all the time. And in most cases, that will create issues in relationship management.
So it's really beneficial in terms of cross-selling, in terms of building that relationship, and possibly in terms of collection as well, you know, if is building that relationship. Is that what you're saying?
Yeah, and also for risk management, because the longer that you deal with the customer, the more it will be easier for you to understand the risk components in the business. In other words, the longer that you deal with them, you will be building that a database, for example, of how this business is running, what are the key points that you have to keep an eye on for this business. The worst things that could happen, if there are any indications of problem loans, then the longer that you have dealt with them, the easier it is for you to see those.
Sure. And we have a response from one of our members in terms of when portfolio grows, there is a point that the loan officer, it makes it difficult for the loan officer to be involved from cradle to grave as the portfolio gets larger without compromising the business and the work that they're doing. So at some point in time, our member is saying from their experience, some of those items do move over to another partner within the bank.
Yeah, in that aspect, there is something that we call the maximum caseload for every loan officer. That has to be set by the institution at the outset. That would depend, I mean, setting the caseload limit depends on the type of product that they handle. For example, from microfinance loan officer, there are two distinctions. If they do a group lending methodology, for example, then the caseload limit will be higher. If they do individual lending, then the caseload will be lower. For SME loan officers, their caseload would be much lower than micro because the profile of the customers that they deal with requires more time on relationship management. So management should set, for example, they would say that a good loan officer should have at most 80, 90, or 100 customers. So when a loan officer hits that limit, then new contacts will be handed over to another loan officer.
We have another question. One of our members has had a situation where loan officers do very, very well, both in their in-house training and their indoor training, and then their outdoor trainings that they're doing. But when it comes to actually doing the credit analysis of a loan client, they struggle in that aspect. So again, doing very, very well in training situations, but do poorly actually with the credit analysis. So do you have any suggestions of how they could improve upon that? or what could be done to strengthen that loan officer?
Mm-hmm. So that brings us back to the loan officer's formation cycle. As what we said, training is just an event. It is just one component of the formation cycle of the loan officer. So it is good to bring them. It is a must that you train them. But after training, there has to be follow-through activities like evaluating the result of the training, whether there's any improvement, and if there's not, of course, the performance appraisal system has to address that. If the loan officer does not show improvement at all, then that is where HR will now come in. If the institution has a well-structured performance appraisal system, then they should be able to handle either digression in performance, or if over time the loan officer does not really improve, then the HR will handle that. But as I said, that formation cycle should be followed in order to identify, for example, the reasons why this loan officer's performance is not improving. What else can we do? Are we giving him the right training? Are we giving him the right support, etc., etc.?
Great. Cecil, are there any other best practices or red flags that you'd like to share with us as a final note?
Yeah. Now, the issue of who should be responsible for training loan officers. Now, this is one of the areas where a lot of confusion sets in. Now, in some institutions, forming loan officers is being entrusted to the head of SME department. Now, ideally, forming loan officers and our staff, for that matter, should be with the HR department. But some HR officers, some HR managers would also say, but this set of people are so, I mean, their skill is so highly specialized, so it would be better if the SME product manager handles it. But let's face it, the SME product manager is mostly inclined to building the business, but not in the business of forming skills, developing skills. So please, if you are faced with that situation, always keep in mind that the human resource department is tasked to do whatever type of staff development program. So loan officer training, formation should be done by the training officer within the HR department.
Great. And it looks like we just had a couple other questions come in. Have you ever done or tried any customer feedback forms or rating loan officers in terms of service behavior?
That is something unique, actually. In most cases, banks would have the suggestion box in the lobby, isn't it? So when the branch manager opens that box, they would sort out the feedback. If, for example, this concerns loan officers, if this concerns tellers, then those feedback will be handled independently. But directly conducting a survey to gauge satisfaction with a single officer, I haven't done that before. What we normally do is conducting a general customer satisfaction survey. Now, actually, in the process of conducting that general customer satisfaction survey, some names would come up, but we don't specifically pick names because there could also be biases. We're not sure. For example, if this customers that you pick, the respondents that you pick, might have some personal biases against the loan officer. Now, objectivity could also be an issue if we pick very specific customers.
Great. Can you speak a little bit about best practices in training of trainers? So you talked, so this maybe could be in terms of HR departments or any other trainers that a bank or financial institution may use?
Yep. Ideally, when you set up your SME department, one of the things that you should also put in place is the pool of trainers. Whether you set up the SME department on your own or if you hire technical experts from outside, one of the first concerns that you must have is identifying who among your staff could be trained as trainers. Now, it would be very good if at the first training, you can already bring on board a team of 3 or 4 or 5 potential trainers, so that as the technical expert introduces the training module, you already have a group of people who will be built up already. Now, in conducting succeeding trainings, this pool of potential trainers should be brought on board in formatting, in enhancing, in revising the training modules. Now, this process is something that you cannot teach them in one setting. So bringing them on board across 2, 3, or 4 training programs is the best approach. One-time training of trainers usually will just be an introduction to the concepts of training and to the topics. But really building the skills of the trainers require a series of mentoring and hand-holding from the technical expert.
Great. And our very last question, again, deals with a potential fraud issue. Is it possible for well-trained loan officers to identify red flags in credit and decide to hide it from their loan manager?
Yeah, you know, some institutions would say that the more seasoned a loan officer gets, the more tricky they become. Now, that happens especially if your internal control is weak. So, personally, I am more careful in dealing with seasoned loan officers, because over time they learn some tricks. But as I said, the single deterrent to fraud is the internal control system. Now, some banks would say it's easier to deal with neophytes because they don't know yet the dirty tricks. Now, remember that in many instances, fraud are insinuated with the customers. They would offer a bribe, they would sweet talk the loan officer. Now, even innocent, quote-unquote, loan officers can be tempted. So I fully agree that more seasoned loan officers are more inclined to committing fraud. And credit managers, field supervisors should take a closer look. And that also brings us to the best practices of rotating loan officers. In some institutions, they would rotate loan officers every 1 year or 2 years, mainly for internal control purposes.
Great. Well, wonderful. Well, we've gone over a few minutes, but we just had such a flurry of questions at the end, and so we'd like to thank everyone for joining us. We hope it was a helpful session, helpful webinar, and thanks so much, Cecil, for putting this together and leading this webinar for us.
Thank you.
If anybody has any final thoughts, please do go to our peer forums on SBBN to post any last questions or other thoughts, best practices, and then also please do take a look at our knowledge bank as well, because we have quite a few documents and tools that could be helpful in terms of some of the questions that were brought up today. So thank you very much, everyone, and we will end here. Welcome to everyone. We are expecting a great turnout today, and we thank you all for participating in this webinar. Let me begin with a brief overview of how this webinar will be run, and then I'll introduce our facilitator. My name is Jessica Alfaro, and I manage membership services at SBBN. I'm very pleased to have met or communicated with several of you earlier and to meet with the rest of you today. We've gone ahead and muted all the voice lines going through to improve the sound quality, but we do encourage you to submit your questions by typing them into the chat box on the GoToWebinar app. There will be several times throughout the presentation that we'll be asking for your input. So we